For most Americans, the primary or the only way that we save for retirement is in our company's employer-sponsored retirement plans. This includes 401ks, 403bs, and 457 plans. Because of this, it's extremely important to understand the ins and outs and all of the rules associated with these plans to get the most out of them and set yourself up for retirement on your terms. So in this video, I'm going to discuss 6 little known facts about 401k plans to help you do just that. And if you own employer stock inside of your 401k plan, you'll want to pay close attention to number 6 on this list. Hey everyone, my name is Jake Skellhorn. I'm a certified financial planner and the co-founder of Spark Wealth Advisors. My channel and my firm are both dedicated to giving you more confidence and clarity with your money. Before I started my firm, Spark Wealth Advisors, I spent most of my career working for one of the nation's largest wealth management firms. A big part of the business of this firm was 401k plan administration. So over the years, I've talked to thousands of different employees and participants in these 401ks and helped educate them on how their 401k plan works and how to maximize its potential. On that note, a lot of the rules that we'll talk about today are IRS guidelines, meaning they apply broadly to all 401k plans, whereas other rules are plan specific, meaning they will vary from employer to employer. One way to verify which rules apply to you is to check your summary plan description to verify exactly what the rules are for your plan. So with that said, the first little known rule or fact about 401k plans is that many of them do not allow you to take partial withdrawals after you separate service from your employer. So this is a big one that I saw all the time at my previous employer that surprised people, especially retirees who just retired and wanted to start taking a monthly withdrawal from their 401k, only to find out that they're not allowed to do that. Again, this is one of those plan specific rules, but in my experience, it was probably about 60 to 70% of plans did not allow this partial withdrawal after termination. My best guess as to why such a rule is so common is because your former employer still pays the 401k record keeper to keep your account open. So this is their way of saying you don't have to go home, but you can't stay here. So the easiest way around this is to roll your 401k over into an IRA where you can take partial withdrawals. But this is definitely something you want to be aware of before you retire so that you can plan ahead and not be surprised. With that said, some 401k plans may not allow partial withdrawals, which is simply a one-time partial distribution, but they may allow installment payments where you set a very specific amount that you take out monthly and may or may not be able to change ever after that. So in most cases, again, it does make sense to roll it to an IRA for that added flexibility, but just double check on what the plan rules are for withdrawals after you separate service from your employer. The second little known fact is that there is a way to contribute beyond the more commonly known IRS limits. For 2024, you can contribute up to $23,000 to a 401k. And if you're over age 50, you can contribute an additional $7,500 for a total of $30,500. Now, if your plan does allow you to do what's called after-tax contributions, you can typically contribute more than that up to the total plan limit of $69,000 or $76,500 if you're over the age of 50. This is something else that's plan specific. Your plan does have to allow you to do after-tax contributions. Again, this is different from pre-tax and Roth. After-tax is almost a combination of the two. So for pre-tax contributions, you obviously get a tax deduction up front, and then when you withdraw that money later, you pay income taxes. Roth is essentially the opposite. You don't get a tax deduction on the money that goes in, but all the money is withdrawn tax-free later when certain criteria are met. So after-tax contributions are somewhere in the middle. You don't get a tax deduction on the money that you put into the after-tax bucket, but when you withdraw that money later, it's tax-free. But the earnings on your after-tax contributions will be considered taxable when you withdraw them later. If your plan does allow for after-tax contributions, you may want to look into a backdoor Roth IRA, which is a common strategy to basically make sure that all the earnings on that money do grow tax-free rather than stay taxable in the quote-unquote after-tax bucket. I did make a separate video on the mega backdoor Roth strategy if you want to check that out after this one. And that brings us right into number 3, which is that your 401k plan may allow you to do in-plan Roth conversions. You may be familiar with Roth conversions, but if you're not, it's simply taking money from a pre-tax account such as a 401k or an IRA and converting it to Roth with the intention of paying some taxes today instead of more taxes later on. Roth conversions are most commonly done from a traditional IRA to a Roth IRA. But many 401k plans allow you to convert money in the 401k from the pre-tax bucket directly to the Roth 401k without ever needing to involve an IRA at all. This is also plan specific, so you'll want to check with your 401k plan administrator or that summary plan description to see if it is offered in your plan. But one reason that you would do an in-plan Roth conversion is if you just want to keep it simple, you don't have a Roth IRA and you want to keep everything in one bucket, you can keep it all in the 401k, but it's really important to note that typically you can't withhold any taxes when you do an in-plan Roth conversion. So you will want to make either an estimated tax payment or be prepared to owe taxes and maybe even penalties at tax time. So going back to those after-tax contributions, many high-income earners will typically max out their 401ks early in the year. If they want to contribute more and their plan allows it, you can do those after-tax contributions and immediately do an in-plan Roth conversion, so all the earnings on that money grows tax-free. Number 4 on this list is to do with investments. A lot of employers will allow you to open a brokerage account within your 401k that will allow you to purchase investments beyond what's offered on your standard 401k fund menu, which is typically about a dozen different mutual funds. A brokerage account, which is commonly known as a brokerage window or a self-directed brokerage account in your 401k, can allow you to purchase any publicly traded investments such as stocks, bonds, ETFs, and mutual funds, or you may be limited to what your plan allows, which could in some cases just be more mutual funds. I think these brokerage accounts can be a blessing or a curse. If you're a savvy investor, they may allow you access to lower cost passive ETFs with, again, lower expenses than what you might have through your regular 401k funds. But they also give you the ability to invest in highly speculative investments like individual stocks or leveraged ETFs, which have exponentially more risk than mutual funds that are available in your plan. So tread very lightly here if you do have this option inside of your 401k. Again, they can offer you a lot more investment choices if you're a savvy investor and you know what you're doing. Before we continue, if you have learned anything so far in this video or you think this is valuable information, do me a favor and subscribe to the channel, like this video, and share it with a friend who may find it useful as well. And rule number 5 regarding 401k plans is coincidentally called the rule of 55. Now, normally when you take money out of any retirement account before age 59 and a half, you'll pay a 10% early withdrawal penalty, in addition to your income taxes that apply, if it is, of course, pre-tax money. But the rule of 55 says that if you separate from your employer that's attached to your 401k during the year that you turn age 55 or later, any withdrawals you take directly from that account will be considered penalty-free. So again, taxes will still apply, just no 10% early withdrawal penalty. Some things to be aware of with the rule of 55 is that, once again, you do have to take the money directly out of the 401k plan, and it only applies if you separated from the employer in the year that you turned age 55 or later. So just as an example, I remember speaking to a lot of clients who asked, I left my employer in the year that I turned 54. If I just wait 1 year, can I access my account via the rule of 55? And the answer to that is no. Also, if you roll your account over to an IRA, you obviously lose the rule of 55. Once again, because the money has to come directly as a withdrawal from the 401k plan. One last thing to be aware of with the rule of 55 is that first rule that we talked about, which is that your plan may not allow any partial withdrawals. So if you are planning to retire early, you definitely want to plan ahead and see if your 401k allows you to take partial withdrawals. If not, you essentially have a one-time opportunity to use the rule of 55. For example, let's say you have $1 million in your 401k plan and you want to start taking out $5,000 per month. If your plan doesn't allow any partial withdrawals, you basically would need to take some out as a withdrawal and roll the rest of it over at the same time to an IRA. So make sure you're planning ahead and figuring out how much you want to take as that withdrawal penalty free before it moves to the IRA. And the last on the list here is what's called net unrealized appreciation. And this is for those of you that have employer stock inside of your 401k plan, and specifically publicly traded stock that you could hold in any other account. So net unrealized appreciation is a strategy that allows you to basically pay long-term capital gains taxes on the growth portion of your company stock rather than ordinary income taxes. For example, if you have $1 million 401k plan and $200,000 of that is your company stock, but you only paid $50,000 for that stock over the years and it has since grown by $150,000. Normally, if you were to withdraw that $200,000 of stock from your 401k, you would pay income taxes on the full $200,000. By utilizing NUA, you would move the stock into a brokerage account, so not an IRA, but an ordinary brokerage account outside of your 401k. You would pay income taxes on the cost basis, which is $50,000 in this scenario. And then when you sell your company stock, you would pay a long-term capital gains tax on the $150,000 of growth. The reason this is beneficial is because long-term capital gains taxes are always going to be lower than your income taxes. The trade-off here is that by utilizing NUA, you do pay income taxes today on that cost basis portion, whereas if you rolled everything in your account over to an IRA, you wouldn't pay any taxes today, but you would later. A couple important things to note when doing an NUA transaction is that you do have to fully deplete your 401k balance within 1 calendar year. In other words, it does require a lump sum withdrawal from your 401k. So you can't simply just move the stock to the brokerage account and leave the rest in the 401k, even if your 401k plan did allow that. Again, the NUA transaction specifies that you have to move all of the money out of your 401k in 1 calendar year. So typically what most people will do in this situation, going back to that example, would be to move the stock into the brokerage account and simultaneously move the rest of the money over to an IRA so that it's not taxed. The other thing to be aware of is that to qualify for NUA, you do have to experience what's called a qualifying event, which includes separation of service from your employer, attainment of age 59 and a half, death, or disability. And your NUA transaction has to be the very first transaction after a qualifying event. So for example, let's say that you leave your employer, that's a qualifying event. You take a $10,000 withdrawal from your 401k plan, and then the following year you want to utilize NUA. Unfortunately, you're no longer able to utilize NUA until you experience another qualifying event, because it was not the first transaction after the qualifying event. NUA is definitely a complex strategy and it may be hard to kind of explain here, so please leave a comment below if you have any questions about it or if there's anything I can clarify. But it is a powerful tax planning strategy to save a ton of money in taxes, especially if you have a large portion of your balance in company stock, and especially if it's highly appreciated company stock. In other words, the current value is worth much more than you paid for it. So I hope you learned something new in this video that will help you maximize the potential of your 401k and set yourself up for a successful retirement. As I mentioned in the beginning, make sure to check your plan's summary plan description or call your 401k plan administrator to check the rules of your specific plan. On the topic of 401k plans, you do have several options with your 401k after you leave your employer. I did make a separate video discussing all the pros and cons to each of these options. If you want to check that one out now, here it is. Thanks for watching and we'll see you there.